Dennis, great to have you on. And that is exactly where I'm going to start with you. The comments that Art Cashin just made about the Fed rarely getting this right, and that tapping on the brakes inevitably leads to slamming on the brakes and the impact that has on the markets and the broader economy. Tightrope to navigate here. How does this play out? Is there a template going back to tightenings of the past that might work the best given the current situation?
I think the current situation is really novel, and the emphasis that Chairman Powell has put on the word nimble tells you that they're trying to navigate this period with essentially a new headset on. They're not probably going to rely too much on playbooks from the past, but they'll figure this one out based on what the data tell them.
So what is the data telling you? I mean, is inflation accelerating? Is it broadening out right now? And if the Fed begins to hike in March, how long typically does it take for a move like that to begin to actually impact and tamp down prices?
Well, the inflation numbers show broadening. There's no question about that. I think there's a little controversy over whether inflation is accelerating. It depends a little bit on what data you actually look at. There was I thought, a good article over the weekend by Jeff Sommer in the New York Times, and he pointed out that the month-over-month numbers have been stable and probably peaked in October. So that's an argument that if you look at the run rate on a monthly basis, the numbers are not accelerating; they're basically flat.
Okay. So if we were to start to see these hikes in March, and then potentially you start to see a drawdown on the balance sheet this summer, which at least for now is what the market is pricing in, how quickly does that begin to change the inflation data outlook?
Well, of course, the long-standing axiom is that monetary policy has its effect with long and variable lags. And that, as a theory, is probably a very sound way of looking at it. Having said that, I think they will be trying to have effect on inflation expectations and consumer sentiment in the relative short term. And there could very well be an effect as the tightening proceeds. And I do want to point out, we've already seen a substantial amount of tightening by the market. So a move that will come in March is, as Jim Bullard said this morning, in a way, a ratification of what the market has already done. So I think you'll see some effects, some taking the edge off of demand. Monetary policy deals with demand. It does not easily deal with supply.
A conversation we will continue to have on a daily basis, I suspect. Dennis Lockhart, thanks for joining us today.